Hello investors. It's been another tough month for the markets globally, in India, and definitely for your portfolio also. The last 6 months have been frustrating in this journey, but the fact is that a lot has changed. We came out of the COVID fall, then the last year we had a whole supply chain issue which led to inflation, and surprise, early this year we had the whole Russian-Ukraine conflict. And this whole the shadow, this whole problem of inflation does not seem to be going away. This expectation of inflation actually shooting up is resulting in a fear that interest rates would be tightened further. This is having an impact on markets globally, and more so on the growth segment of global markets. Let me share with you a few charts which will really help us understand where we are, and more importantly what we are doing with your portfolio, so that as and when the markets recover, we will recover out very fast. We have made a lot of changes, we continue to do that, and we think that that is very centric to our basic philosophy of trend investing, which is being aligned with the trend. As I told you, the trends have been changing and there are good reasons for that, but we have been active. We are worried about the drawdowns, we are worried about the pain, but at such times the important thing is not to put your head in the sand, but actually to go out and be proactive. So let me share the first slide with you. The first slide you see on your screen is the Nasdaq. The Nasdaq is nothing but a great representation of growth stocks. You will see from the November highs, the Nasdaq has corrected about 31%. And that is putting it very mildly, because this Nasdaq has been relatively held up by a few large stocks. However, most stocks in this space, which are a good representation of growth, have come up more than 50, 60, 70%. So this really brings out the cause or the effect, that pain we are having due to expectations of higher inflation and higher bond yields. As far as India goes, compared to the 52-week highs which we set out in October, you'll find that the Nifty 500 is down 12 to 13%. There are some sectors which are doing relatively better. Not that they are making money, but they are falling less, and there are about 7 of them. But the number of sectors that are outperforming is almost double of that. So this really shows you that how even in Indian markets, the pain in portfolios in stocks is much more than is being represented by the index. I mean, look at something like the IT space, or metals, or media, financials, banks, pharma. These are the growth areas, and you will notice that the decline here is much more than what the index is showing. And that is offset by some sectors which really have not fallen less, but honestly they were not the ones that were either trending more, which is autos, FMCG and some MNC spaces. So that really is how Indian markets are. Indexes show it's bad, but not as bad. But the fact is that a lot of sectors and stocks have fallen a lot more. In fact, those places where most of us were, which is the growth spaces, have actually fallen a lot more than the underlying Nifty 500 benchmark. Even if you look at the distribution of stocks, this is a slide I've borrowed from somebody else, but the green vertical line represents the index. So the index has fallen 12-13%, but only 10% of the all NSE stocks have fallen less. 90% of stocks have fallen more than the index from its recent peak. In fact, you'll find that 30% of the stocks have fallen anything between 30 to 45%. So that really shows you the nature and the color of this market. And as I said, the 10% that have done better have been places where no investor would have been. Some of the PSU oil stocks or some of the commodity plays. Majority of the investments were in the segment which is to the right of the green line, and that actually is the reality of today. And that is why we feel the pain, and we feel that this is a time for us to remedy and to realign our portfolio, and we have been working on that, which we are going to share with you very soon. Well, the issue, as I said, has been commodities. And let's just look. You can see that from 2020 lows, that is COVID lows, the commodity index has gone up 220%. Mind you, the CRB index is nothing but a summation of global commodities, and crude and energy has a very big play. The first half, which is the black line, was a representation of the restart trade where there were global supply chain issues, but those were man-made and sooner or later would settle. But the pain, the extended pain that we are feeling in the last 4 to 5 months is because what's happened due to the unexpected Ukraine and Russia war. This war was also expected to be a little short-lived. However, it seems to be extending. And the world is coming to believe that, hey, this commodity rally or this commodity move is going to be longer than expected. And this is what is causing the current panic. Of course, these are things we do not know, and we know that this is more geopolitical in nature. These can get solved also very quickly. Leaders can change their minds very soon, and this can reverse. But till then, the fear of commodities having an elongated, sticky bull market still remains. Now, as far as your portfolio goes, as I said that we have been active, we feel confident that it is important to align with the change in trend, because when markets reverse, we feel that these are the stocks that will outperform on the upside. So let me share these stocks one by one with you. Of course, along with this video, you will have a detailed research report on each of these companies, so you will be able to understand the fundamentals and the thesis as to why we have bought these stocks. The first stock we have added is Hindustan Aeronauticals, HAL. Very unconventional for our style of investing. You know, it's a PSU and it's in the defense space. But what we are seeing is that due to the government's Make in India shift, Buy in India shift, almost 70% of defense equipment has been reserved for manufacturing by Indian entities. And HAL is an outstanding player in the aeronautical space. We feel that this sector is poised for growth, and given its very robust order book and execution capabilities, we feel that HAL will deliver in the long term. HAL is an outstanding company. Always the shadow of being a PSU has remained, but it has strong design and development capabilities. And more interestingly is that it's diversifying into civil aircrafts, because if that clicks, this could be a very big game changer for Hindustan Aeronauticals. The details are in the attached report along with this mail. The second stock we have added is Varun Beverages. Now, Varun Beverages is a very little known company but touches all our lives. In fact, all Pepsi products which we consume are manufactured by Varun Beverages and even distributed by them. So the Pepsi and the Sprites and the Tropicanas and the Aquafinas that you consume are actually manufactured by Varun Beverages. Pepsi only does the marketing bit of it. And what we have seen is that the earnings momentum has been very steady, in fact improving due to excellent execution abilities of the management. And more importantly, they have acquired new territories in South and West of India. And this, I think, is going to be a further feather on their cap. And I feel that going ahead, we will see this backward integration, margin expansion playing out, and this will help in bettering the return ratios. And that is why we feel bullish on this FMCG play, Varun Beverages. The third stock is a technology stock. The contradiction is that technology is correcting globally and we bought or replaced a technology stock. The reason we have done that is because Tata Elxsi is a very special play. This is a very strong digital engineering company. It has great capacities and it is very involved in the automotive side of the digital play. You know, a lot of these autonomous self-driving cars, you know, all your cars today are very, very dependent on the softwares that go into it. And Tata Elxsi works on that. And the beauty is that when they get into these jobs, they are very long-standing relationships. You know, the whole engineering development stage takes years. And this really helps them to have deep relationships, which results in superior margins. And we feel that this emphasis on long-term deal contracts in a very exciting space of technology and automation is what will really keep Tata Elxsi miles apart from most other IT plays. So we feel very bullish in Tata Elxsi, in spite of what is happening in the digital and tech space globally, because we feel that this is a standout player. The fourth stock that we have added in the last few weeks for you is Tube Investments. Now, Tube Investments is the flagship company of the Murugappa Group. Now, this is a very, very famous South-based family, great corporate governance, they have excellent track record, and Tube Investments actually is known more for the cycle business, which is the Hercules brand. However, we feel that the company has moved well beyond that. They have focused a lot more in the engineering space, and we see them get into industrial segments like railways, power, and we feel that this capability of engineering of Tube Investments is something which they will be able to leverage to improve their performance going ahead. So to sum it up, these are the 4 companies that I've added to your portfolio. Again, very different from what portfolios have been in the last few years. In the last few years, we and the market has concentrated on few niche growth companies, which obviously have become very, very expensive. But we feel that in the change environment, these stocks or sectors, the companies will do well, but the markets will not reward them. The markets are, we feel, getting much more broad-based, and that is why we are moving your portfolio to a much more broad-based space. We have a lot of catch-up to do. We are aware of that, and we are working on that. So we feel that this strategy or this aligning with the larger trend, where we see the market move away from this narrow growth basket to a much more broad industrial kind of play, is what will be good for you, and we are showing that in our actions. With that, I leave you for this month. Times have been tough, but we also have been holding on. We have been working very hard. Nobody likes to go through drawdowns and pain, but I guess that is a part of the market. But more importantly, being proactive, taking actions and trying to remedy is what I think is more important, and we are definitely at it in a very focused manner. With that, I leave you for this month. Thank you very much.